A growing number of Ugandans are starting to get interested in investing in the stock market, especially the US international stock market. It's because, like so many investors say, the US stock market is the greatest wealth making machine there is. There is nothing comparable to the US stock market. Uh, Actually, when you think about all the investment opportunities and options available, the equities market has the highest upside in the longest run. Yes, the fixed income products we have, especially in our countries like Uganda, they somehow, somewhere are comparable to the equities market, but in the long run, the equities market is way, way much better. It's just that many of us who are based in Uganda might not always have the opportunities to invest in the US stock market. Why? Because of the enormous amount of capital that it requires, but two, we do not have the information, and we are starting to just bring up this information for so many people to make these types of investments, which we believe are much more important right now as part of the diversifications. We cannot underestimate the risks that we are facing in a country like Uganda. One, the political risk is picking up. We cannot underestimate it. But two, the concentration risk. In Uganda, our stock market is not that great. It's good, it's picking up, but it's not that great. We do not have even more than 5 companies you can take home and feel like these are companies I can invest in. Two, when you think about those companies, the liquidity, the float is limited. When you talk about companies like Stanbic Bank or Stanbic Holdings Uganda, 80% of that is controlled by one shareholder, the group company. The other 20%, when you take off what NSSF controls and a few other provident funds and a few other fund managers, you remain with around the 2 to 3% float, which is in retail investors who here and there might want to buy and sell. The same with MTN, the same with Bank of Baroda, the same with DFCU. It's everywhere. So then you're like, okay, however much I want to invest in the equities market, the Ugandan market starts to become a little bit limited. Then you're like, what do I do? But at least for in the Ugandan market, there are a few companies that if you end up wanting to invest in the Ugandan market, when you have to choose a company to invest in, there are not so many. You will always get something that is 4 or 5. That's what even if you have to do fundamental research, you can easily align and get something to invest in if you can get the float. It's not the same in the US market. The US market is more complex. And that's where lies the opportunities. There are so many listed entities for different, in the different sectors. Right now in 2026, we talk about the AI boom. It's hard to know how many companies right now are out there that are doing either starting off, they're about to get IPO'd and they have a footprint in the AI or AI-related kind of industries like the semiconductors, like the data centers. One of my latest company that I'm stocking up is Oracle. You know, Oracle is down by almost 60% from its highs. Yet someone will tell you Oracle has close to $500 billion in commitments to its data centers that it has yet to fulfill. I want to bet that they will find a way, but at one point it was as high as $300 per share. Now it's in 125, and I'm stocking it up because I know if they figure it out, we shall be in the money, right? Some people feel like the wave of Nvidia left us, but then we missed out on the Micron, we missed out on the SanDisk, we missed out on almost all these other small companies, the Nibias. That the AI boom is not just bringing up the AI companies, the frontiers, you know. To so many of us might not have got some allocation with the SpaceX IPO, but we know Anthropic is coming. We know OpenAI is coming. All those are IPOs. But it's hard to even predict to say if a company is going to get listed at a valuation of $1 trillion, what is the upside? At what point will it be 3 trillion for me to 3 times my money? Then you're like, you know what? This industry is not just about the companies that are at the frontier of this technology. It's about also the other companies that are supporting it. Many of us in Uganda, if you grew up, if you used some computers in the early 2010s and up to 2020, at that time, part of our transfer of data was through the SanDisk, right? You move with your SanDisk, you give it to someone, they were secure. They had big storages, 200 GB. You can get that data and move movies, music, everything. Yet that company was there listed at around that price at a below price for close to almost 8 years. Little did it know that the AI boom will unlock its potential of its data centers and its data capabilities. That in the last 1 year, it has grown from as low as, was it 200 to almost 1,000 plus. It has tripled its value. And it's not about the such companies. But the point here is the complexity of the stock market in the US is hard. That sometimes it can be scary. And that's where lies the solution. Sometimes you don't need to buy the companies themselves. Sometimes you have to appreciate the ETFs, the exchange and traded funds. They are quite a number. Quite a number. There are some people right now who for them have said, I do not have time to choose which company is going to make it better in the semiconductor industry. They are buying the semiconductors. ETFs. Some of those ETFs have been growing at an average return of 20%. In 2023, 2024, some of those had a booming return of over 40%, though it has slowed down. There are those who have decided to go at I'll go technology because almost all the companies in the tech industry are embracing AI. Of course, some companies that are doing the SaaS, software as a service, are getting impacted because of the AI. AI is changing their game. The Salesforce of this world. But it's not a doom yet. The opportunities are enormous. To the people who are not so much complex into making sure that they can think beyond that, just buy the S&P 500 indices. Go buy the simplest of an ETF, the S&P 500, the QQQs, that tracks the Nasdaqs. At least that way, you know, I have exposure in the ETFs that either track the S&P 500 or that track the Nasdaq 100. Don't complicate it. To others, you might love certain industries, the healthcare. It's getting, AI is giving the healthcare industry an enormous boost. Not just a boost because of what they are, but because of the potential that it's presenting on the table. You go buy those. Look for the ETFs that have more exposure in the healthcare industry. It's getting revolutionized. The research that used to take 10 years or 5 years, the AI is almost going to enable them to take it for maybe a year. There's opportunities for those companies to add value. So just buy the ETFs. You know, to some people, you'll be like, you know what? I want exposure to the Asian industry, to the Asian market, to the Asian tigers. I do not know which companies I need to buy if I'm to go to Asia. That's okay. That's okay. That is where the opportunities lie. Just look for the ETFs that have the emerging markets and Asian market. You will be surprised on how many companies there are. How many ETFs there are that track and have their holdings are so much for the Asian market. And you get that exposure. And they are doing some really, really well. They're actually doing much, much better than some of what we know. ETFs that track the small cap index on the S&P on the New York Stock Exchange. Why? Because the small companies always have a higher upside. If the company is 20 billion, but it's in an industry that is getting revolutionized every single day, it can wake up one day when it's from 20 billion to 100 billion. 5 times your investment. So if you do not know how to choose those companies, the ETFs become your guiding principle. And that's how we're going to kind of revolutionize for those people who are trying to invest in the US stock market. So do not complicate it. Do not look at it from a perspective of what do I need to do? Where do I need to go? Who do I need to talk to? The stocks on individually are way better, are really good. But the risks with that is also higher. So if you're not so much complex, if you cannot evaluate which stock to buy, then you go, like many of us, go to the ETF side and build your portfolio slowly but sure. It will get done. You'll get exposure to most of these companies. If one company is suffering and a few other companies that are in the green, you'll balance your portfolio out. If the whole industry is in the red, you'll be in the red. If the whole industry is in green, you'll be in green. You will at least have an exposure of a good return. And majority of these ETFs are managed, are set up and managed by some of the best professional investment managers we know of: the Invesco, the Blackrocks, the Fidelity, the Vanguards, the State Streets of this world. They're some of the biggest of the biggest, you know. So the choices are enormous. The choices is yours.